Hey guys, hope you are all having another great day. We have a great deal of things to discuss, and one of them is going to be the reverse repo operations conducted by the Fed. I have been getting a lot of requests asking me what is going on, why the operations are climbing, and what does it mean for the overall economy. I have covered this multiple times before, but with new investors coming in fresh into the grind, I figured why not. Besides, there is a couple of things that everyone should be aware of. On top of that, we have some pretty wild stuff happening with Loopring and hedge funds. Let us Tokyo drift once again into the matter at hand. Also, if you missed it, I made a morning video discussing some pretty important stuff. I will link the video in the comments below in case you missed it. Before we begin, let me quickly state that I am not a financial advisor, and that all content discussed in this channel is simply information gathered that I deem important for people to know, so that they can make informed decisions. All efforts are aimed to better understand the nature of the current market in anticipation of the greatest squeeze in financial history. Let's get started. What better way is there to describe the current economy than to begin with the repo market? The repo market is a form of short-term borrowing for dealers in government securities. The way it works is, a dealer sells government securities to investors and then buys them back the following day at a slightly higher price. In other words, it serves as a loan of sorts for the entities that engage in these types of transactions. The repo market is a market for repurchase agreements, the marketplace where institutions trade cash for collateral. Let's say you were an institution, and you needed cold hard cash to make good on your debt, but you don't get paid until tomorrow. In order to get the money, you go to an institution in the repo market and make a repurchase agreement where you exchange some of equal value to the cash you are going to get, say your car for example, and in return they give you the cash. You now can make good on the payment, and tomorrow they give you the car back when you give them the cash back. Again, it's a repurchase agreement where you both agree to repurchase the asset you are exchanging for a small fee. Now, let's start bringing the topic back to topic. In the financial system, if you have more collateral, like treasury bonds, and less cash, you will see interest rates in the repo market going up due to basic economics. More people need cash, but there isn't a lot to go around, so you can benefit by making interest rates higher. This works backwards as well. When there is a lot of cash around, interest rates are going to drop simply because there is too much supply for the demand. Now, let's go back in history to 2008 and the events leading up to it. There was a signal that a crash was coming in the repo market. Repo interest rates surged up, making it harder for financial institutions to access cash for their funding. The problem was that during those years, as we have discussed many times on this channel, the collateral that was popular was mortgage-backed securities. No, as you know, mortgage-backed securities were problematic because their worth was highly overinflated. Institutions are not dumb, they knew what was up, they were just passing the hot potato around ignoring the problem until things got strained in the economy, and all of a sudden, they did not want to accept mortgage-backed securities as collateral. They knew it was worth nothing, so they abstained themselves from buying. When some of these institutions stopped playing ball, the institutions that had the hot potato, or too much mortgage-backed securities, too much collateral at the time, were stuck. There was nobody willing to do repo transactions with them. As you can see, history taught us that institutions will not play ball once they understand that the collateral being given is overinflated in value, and when things get strained, everything sort of freezes. Now, let's bring the topic over to the modern day. In September of 2019, interest rates spiked, leading to many headlines being published with public worry of what is about to come. We learned the lesson that spikes in these rates means something bad is looming around the curve. This year, the spikes for the reverse repurchase agreements have been spiking as a growing trend. A reverse repurchase agreement is the agreement to lend the collateral or cash to another party and collect the small fee on top of it. So going back to the example we made, the institution giving you the cold hard cash would be engaging in reverse repo agreement. Spikes in reverse repo agreements are normal, but right now we are not just having a spike here and there before it goes back down. We have a full growing line that keeps going up and up. The Fed keeps on having to sell treasury securities. The amount of financial institutions relying on reverse repo is at a record amount, so much so that interest rates went negative at a point this year. The Fed has been working with the Treasury close in hand. The Fed knew they were going to inject a ton of cash into the system, something that would spiral things out of control and directly into a market crash if it wasn't controlled. They also knew that they were going to be engaging in many high reverse repo operations because of how much collateral versus cash is in the system. They plan this to be a temporary mean to handle this dilapidating economy in the meanwhile. Now, let's be practical. The problem with the plan is that it's not going as well as intended. The Fed keeps telling us everything is temporary and that things will even out soon enough, but I have my own personal issues with this. The system is very delicate, because whatever you do or change to control a certain factor on one side will have a very explosive effect on the other. What happens when something stops working as intended all of a sudden? Well, the Fed quickly goes and tries to fix it, but then by fixing that, something else starts to break in the system. All of a sudden, they have too many things breaking, not working as intended, and then there is no plan or rescue proposition to save the day. The Fed attempted to fix the economy as a result of the pandemic last year by essentially imposing themselves as a central control over every aspect of the economy. They articulated that by imposing themselves as dictators of a free market society, they would be able to keep things from crashing, but as we are now seeing, this has not been the case. What has happened is that, because of the high complexity by which modern financial systems operate, this is almost impossible to do, especially given the hidden agendas like insulating Wall Street from damages from the pandemic. As such, because the system was biased, the attention to problems was tilted. As a direct consequence to this, we now have the Fed who has shown they cannot control anything. They have sort of given up on trying to fix things based on the comments Powell has made, and they are sort of flowing around with whatever happens. He already said that if the economy collapses, they are not at fault. That statement resonated with me a lot, because it indicated his psychological approach to this. All hands are on deck, but there isn't enough strength to steer the ship in the direction they want. Today, 69 days have gone by where the reverse repo market has been higher than $1 trillion. This is absolutely insane, but Jerome Powell did tell us, and I quote, "Everything is fine, it's all working the way we expected it to." I still have yet to decide if this man is a genius imposing as a dummy to purposely crash the system, or if the entry level to chair of the Fed has become so abysmally low that anyone can get it. The storm they have caused is too powerful, and wherever the ocean takes us is where we will go. I have yet to see a single factor, a single function produced either directly or as a consequence to a directive by the Fed that has worked exactly as intended, aside from insulating Wall Street from the crash. They preserved these goons at the expense of the world, and ironically enough, ensured that they too will be the ones paying out cold hard tendies to dumb bets Wall Street decided to make with GameStop and AMC. I hope this video gave you a basic overview of the situation, and helped you understand where we sort of stand. Though not highly detailed as my previous segments on it, it is a good summary of what you need to know, what led us to high spikes that continue to grow, why we are where we are, and why I invest in AMC and GME. Moving on, hedge fund Balyasny has banned firing from Ken Griffin's Citadel unit. This is an incredibly rare halt among rivals that have many times poached talent from each other. The investment firm told headhunters earlier this month to not recommend potential staff from Citadel, and the ban extends to anyone who works there or supports the business overall. Balyasny did not provide any reason for this and has declined to make any comments. I want to take a brief moment and say I told you so. I told you guys that everyone in Wall Street knows exactly what is going on. The media is playing it down, but everyone employed in the financial sector knows what is happening. I do not blame Balyasny for banning hiring Citadel employees or supporters. It is a very risky proposition to make, especially given that these employees themselves helped architect and ensure the biggest exchange of fortunes that is yet to transact. I know my boy Kenny is low-key mad, as this will further stain his public image and his competitive reach. They can keep the ball rolling, but we know that at a point in time, it's going to stop, and that's when we launch off to Lambeau Town. Loopring Organization's Twitter account stated, "Where we are going, we don't need intermediaries." An amazing tease of things that are yet to be announced and happen. This statement has me all jacked. It is exactly what I wanted it to be. The anticipation for their relationship status announcement with GameStop has me too pumped these days. We need a full financial reform, and I think Loopring, if they decide to expand over the years, could be the first ones to take the bold first step in ensuring a fair balanced market. For now, like I said, I keep on buying meme stocks since they are the ones that are going to squeeze, but a Loopring here and there with spare change from the gas station or my wife's boyfriend pity cup won't hurt. Let's now talk about today. The Fed submitted over $1.584 trillion in reverse repo operations today, a number that quite literally dropped my jaw. We are literally halfway there to $2 trillion in reverse repo operations on a daily basis. This whole system is so decrepit, I honestly am astounded it has legs to stand on right now. Dark pool trades for AMC accounted for 62% of the total volume today, while dark pool trades for GameStop accounted for 41% of the total volume today. AMC had a larger amount of buy orders than its sell orders, with GameStop presumably also having a larger amount of buy orders than sell orders. Now, let's talk about performance. AMC traded bearishly, losing over 4% for the day. It began trading pretty bullishly during the pre-market, running up and past 42.40 twice. Upon market opening, however, AMC was heavily attacked and dipped, going down all the way to 40.20. It would bounce up slightly, eventually testing and breaking the VWAP to move to 41.35, but would be unable to hold support, and it would then fall back down, this time breaking the support it built at 40.20. After reaching 39.79, the lowest point of the day, AMC would begin bouncing up, but its momentum and strength was weak. AMC closed at 40.41, below the VWAP. As for tomorrow, AMC will have support at 39.78, 39.02 and 38.46 if shorters really get ambitious. Resistance will be met at 40.50, 40.63, 41.38 and 41.73. It is clear that tomorrow, shorters will attempt to drop the price below 40.01 by the end of the day. Let's hope we have a nice rally and elevate the price up. GameStop traded bullishly, gaining under 1% for the day. It opened to some volatility that took it from 210 to 215. After reaching there, GameStop would be heavily shorted, being taken down to 209, where it would then bounce up above the VWAP for a brief period. After failing to hold support at 212, GameStop dipped again for much of the rest of the day, eventually testing 207.66. It would bounce up close to the end of the day, closing at 210.12. As for tomorrow, GameStop will find support at 208, 206 and 203. Resistance will be met at 210, 212 and 215. It is clear that shorters will want this price below 210 by tomorrow's end of the day, so let's hope for another rally to push this up. That is all I have for you guys today. Let me know your thoughts down below in the comments. I hope I was able to help some of you understand some key aspects of the economy and where we are. Remember to watch the morning video if you missed it. If you want to support this channel, I have a Patreon link in the description as well as some one-time donation links for Cash App and PayPal. Thank you again for being a part of this channel. I will continue striving for better content. Enjoy the rest of your day and to the moon.